Have you ever opened a trading chart and just been hit with this tangled mess of lines and colorful clouds? Well, chances are you've just met the Ichimoku Cloud. It looks incredibly intimidating, I get it, but today we're going to untangle this thing and show you how you can actually use it.
Okay, let's just dive right in with a pretty bold claim, right? The idea that this incredibly busy-looking indicator is secretly simple, it just doesn't seem to add up. But believe it or not, that was the entire goal, to give a trader a complete picture of the market with just one single glance.
Yeah, I know. Looking at this, simple is probably not the first word that pops into your head. It seriously looks like someone just scribbled all over a perfectly good chart. But stick with me, because I promise, by the end of this, you'll see right through the chaos and understand the powerful system that's hiding in plain sight.
So the indicator's full name is actually Ichimoku Kinko Hyo, which is Japanese for one-look equilibrium chart. It was created way back in the 1930s by a journalist named Goichi Hosoda. See, he wanted to build one single tool that could pack a ton of information into one view. And to do that, he built it with 5 key parts.
And here they are, the 5 core components of the system. The best way to think about them is like a team, where every single line has a very specific job. You've got faster and slower lines to track momentum. You have 2 lines that actually project into the future to form that cloud, and then you have one that looks into the past for confirmation. Look, we don't need to get bogged down in the exact math right now. Just know that altogether, they're designed to give you a complete picture of the trend, momentum, and support and resistance. Let's start with the most obvious feature on the chart, right? The part you can't miss. That's the Kumo, which is just the Japanese word for cloud. This big shaded area is really the heart of the indicator, and it gives us our most basic, high-level signal about where the market is headed. And this, right here, is the first and most fundamental rule of Ichimoku trading. It's super simple. If the price is trading above the cloud, the overall trend is bullish. You should be looking for reasons to buy. If the price is below the cloud, well, the trend is bearish, and you'd focus on selling. And what if the price is trading inside the cloud? Think of that as a neutral zone, a place of uncertainty, where you might just want to wait for a clear signal.
Now, the cloud isn't just a static blob either. It's actually projected 26 periods into the future, which gives you a sort of forecast of where potential support and resistance might show up. And its thickness tells a story too. A really thick cloud suggests there's been a lot of volatility in that area, meaning it's likely a strong barrier. A thin cloud, on the other hand, represents much weaker support or resistance.
So here's the crucial part. How do we turn all this info into actual trading strategies? I mean, knowing the trend is great, but we need clear signals to actually enter a trade. So let's look at 2 of the most popular ways traders use the Ichimoku Cloud. The first one is the crossover signal. And hey, if you're already familiar with moving average crossovers, this is going to feel very intuitive. It uses 2 of the lines we mentioned, the Tenkan-sen, that's the faster conversion line, and the Kijun-sen, the slower baseline. And you can see that signal right here in action. The faster blue line crosses below the slower red line. But what makes this a really strong signal is where it happens. Because the price is already below the cloud, this crossover just confirms that bearish momentum, signaling a potential opportunity to sell. And a bullish signal? Well, it's just the exact opposite. A blue line crossing above the red, while the price is already above the cloud. Okay, our second core strategy is the Kumo Breakout. Now, instead of watching the lines cross each other, this strategy focuses on the price itself crossing the biggest barrier on the whole chart, the cloud. A Kumo breakout is a really powerful signal. When the price has been stuck below the cloud and then it decisively breaks out above it, just like you see here, that can signal a major shift in market sentiment from bearish to bullish. It suggests the buyers have finally taken control and a whole new uptrend could be starting. All right, so now that we know how the basic parts work, you'd think the logical next step is to combine all 5 signals for the strongest possible confirmation, right? I mean, that's how it was designed, as an all-in-one tool. But what if I told you that more is not always better? This is the key question, really. The indicator was created to be this holistic system where all the parts are supposed to work together. But do they have to, or could traders actually get better results by just using the components individually? Let's look at 2 competing ideas. So on one hand, you've got what we'll call the Swiss Army knife approach. This is the traditional view. Use all 5 parts together to get this complete, confirmed picture of the market. But on the other hand, you have the scalpel approach, where you pick and choose the single best component for a very specific job. It's that classic debate, do you want comprehensiveness or do you want simplicity?
And this is where it gets really fascinating. A study published by Atlantis Press actually backtested different Ichimoku strategies on 35 stocks over 2 years. And just look at these results. Using the entire system, yeah, it produced a higher average return. But look closer. It was only profitable on 45% of the stocks. And the risk? The deviation was a massive 23%. Now, look at what happened when they used just one single component, the Chikou Span. The return was a little lower, but it was profitable on an incredible 91% of the stocks, with only about a quarter of the risk.
So what is this superstar component, the Chikou Span, or lagging span? Is literally just the current closing price, but plotted 26 periods in the past. Its whole job is to give you a quick visual of how today's price compares to where the price was about a month ago. And that study suggests this one simple confirmation tool, all by itself, provided the most consistent and least risky trading signals of the whole bunch.
So what you should really take away from all of this isn't just how the indicator works. It's a much deeper question about how you apply technical tools in your own trading. The data really challenges that conventional wisdom that more complex is always better.
And that leaves us with one last, kind of provocative question. Is the Ichimoku Cloud truly a one-look system, like its name says, demanding you use every piece together? Or is it more like a toolkit, where sometimes the most effective strategy is just to pick the single, simplest tool that's right for the job? The answer might change how you look at not just this indicator, but maybe your entire trading approach.